Okay, real talk. You opened your Swiggy app last Friday, spent 680 rupees on biryani, felt a tiny bit guilty, closed the app, and then told yourself, okay, from Monday, I'm being serious about money. And then Monday came and went. Here's the thing, I'm not judging you. I've been that person. Most of us have been that person. But what if I told you that the 680 rupees biryani isn't actually why you're not financially free? What if the real problem is the 20 rules about money that nobody ever taught you and some of them are going to genuinely shock you? I'm Rohan and I spend way too much time thinking about why smart, hard-working Indians are still living paycheck to paycheck despite earning more than ever before. If you're someone who earns a decent salary, feels like money just disappears every month, and has no real idea when or if financial freedom is ever going to happen for you, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. Today we are doing 20 rules, not tips, not hacks, rules, the kind you build an entire financial life around. Let's go. Rule 1. Your salary is not your wealth, your savings rate is. Look, India's net household financial savings rate collapsed to roughly 6% of GDP in FY 2025, according to RBI data, the lowest in decades. Meanwhile, countries like China sit at around 35%. That gap is not a coincidence. Here's the brutal math. If you earn 1 lakh rupees a month and save 5,000 rupees, a 5% savings rate, you are, financially speaking, poorer than someone earning 40,000 rupees and saving 12,000 rupees, because savings rate determines your timeline to freedom, not your salary. A 50% savings rate means you can retire in roughly 17 years. A 10% savings rate, 43 years. Same income, wildly different outcomes. The rule: stop bragging about what you earn, start obsessing over what you keep. Rule 2. Inflation is eating your money silently and it's worse than you think. India's headline retail inflation actually dropped to around 3% in 2025. Sounds great, right? But here's what most people don't realize. That number masks what's actually happening to your wallet. Your SBI savings account now earns just 2.5% interest. Official CPI figures for education and health show 3 to 4%, but the cost of medical insurance is rising at 9.9% a year per Mercer Marsh. And lifestyle costs in Tier 1 cities, rent, dining, subscriptions, are quietly outpacing official numbers for anyone living a modern urban life. That 10 lakh rupees sitting in your savings account at 2.5% interest, after tax, you're essentially earning nothing. And against real-world cost increases in healthcare and urban living, you're falling behind. The rule: any money not growing faster than 6 to 7% in real terms is quietly shrinking, full stop. Rule 3. The 50-30-20 rule is outdated for India in 2026. Use 40-20-40 instead. You've heard 50% needs, 30% wants, 20% savings. That was written for a different world. With urban rent in cities like Mumbai, Bengaluru, and Hyderabad consuming 30 to 40% of take-home salary alone, the old model breaks immediately. Here's what actually works for the Indian middle class right now. 40% fixed non-negotiables, rent, EMIs, utilities, groceries. 20% lifestyle and wants, dining, travel, entertainment. 40% wealth building, investments, SIPs, emergency fund, insurance premiums. Yes, 40% to wealth building sounds aggressive, but this is what financial freedom actually requires. It's not comfortable, that's the point. The rule: make wealth building a non-negotiable, not a leftovers activity. Rule 4. Your EMI is someone else's SIP. This is where it gets really interesting. Every EMI you pay, for that car loan, that personal loan, for the iPhone, that buy now pay later on Bajaj Finance, you are literally running a systematic investment plan on behalf of the bank or the NBFC. Their wealth is compounding, not yours. India's total retail credit outstanding crossed 53 lakh crore rupees in early 2026 per RBI data. Consumer credit is growing roughly 12% year on year, much faster than most people's incomes are growing. We are borrowing faster than we are investing. A 5 lakh rupees car loan at 9.5% over 5 years, you will pay back 6.27 lakh rupees. That 1.27 lakh rupees of interest invested at 12% for 5 years would have been worth 2.23 lakh rupees. The rule: every loan you take is an investment you cancelled. Rule 5. An emergency fund isn't conservative, it's the most aggressive thing you can do. Now you might be thinking, Rohan, keeping 6 months of expenses in liquid cash is a waste when the market is running. Here's what happens without an emergency fund. Market crashes, you lose your job, you're forced to sell your mutual fund units at the bottom to pay rent, you wipe out years of compounding in one panicked moment. Amphi data from the 2020 crash showed massive net outflows from equity funds during the March to April dip. Months of positive SIP inflows wiped out as panic set in. Most who redeemed sold at the bottom, locking in losses permanently. An emergency fund is what keeps you from becoming that statistic. Keep 6 months of expenses in a liquid fund or high-yield savings account. That's it. Non-negotiable. The rule: emergency fund first, investment portfolio second, always. Rule 6. Term insurance is not an investment. Stop looking for returns from it. I cannot tell you how many times I've seen people buy ULIPs or endowment policies because it gives returns and coverage, and then they show me the fine print. A 1 crore rupees ULIP with 1 lakh rupees annual premium gives you IRR in the range of 4 to 6% after all charges. A pure term plan for 1 crore rupees coverage under 12 to 15,000 rupees a year for a 30-year-old non-smoker male. The difference? The remaining 85,000 rupees plus invested in index funds at 12% CAGR for 30 years becomes 2.55 crore rupees. Keep insurance and investment completely separate, always. The rule: buy term, invest the rest. It really is that simple. Rule 7. Real estate is not automatically a good investment. This one will upset some people, but it needs to be said. India's average residential rental yield is 2 to 3.5% per Analog Research 2025 data. Compare that to Nifty 50's 10-year CAGR of approximately 12.8%. Even with property appreciation, once you factor in stamp duty 5 to 6%, registration, maintenance, property tax, brokerage on exit, your actual IRR on most residential real estate in Tier 1 cities is 6 to 8%. Real estate works as diversification. It doesn't work as the strategy. The rule: don't buy property to get rich. Buy it when you can comfortably afford it and want a home. Rule 8. The stock market is not a casino unless you treat it like one. Here's a statistic that should sit with you. A SEBI study released in 2024 found that 93% of individual F&O traders lost money over a 3-year period. 93%. But the same Nifty 50 index held through a boring SIP over 20 years has never given a negative return to patient investors. Not once. The market punishes traders, it rewards owners. If you're in F&O options without a genuine professional grade edge, you're not investing. You're donating money to institutions with superior data, faster execution, and zero emotional decision making. Rule 9. Starting at 25 is worth 3 times more than starting at 35. Let's do the actual math, because this number is genuinely wild. Priya starts a 5,000 rupees monthly SIP at 25. Rahul starts the same 5,000 rupees SIP at 35. Both stop at 60. Both earn 12% CAGR. Priya, 5,000 rupees a month for 35 years equals 3.24 crore rupees. Rahul, 5,000 rupees a month for 25 years equals 94.9 lakh rupees. Same amount per month, same returns. The difference? 2.29 crore rupees, just because of 10 years. This is not a motivational poster. This is compound interest working exactly as mathematically promised. The rule: starting today beats starting perfectly tomorrow. Every single time. Rule 10. Your biggest wealth building asset isn't your portfolio, it's your income. Here's what most people don't realize about financial freedom. It has 2 levers: returns on investment and income growth. And for the first 10 to 15 years of your career, income growth is the bigger lever. A 30% salary hike invested, not lifestyle inflated, does more for your net worth than optimizing your portfolio allocation for an extra 1% return. India's job market data from TeamLease and Naukri.com for 2025 to 2026 shows average tech salaries growing 8 to 11% year-on-year in Tier 1 cities. But lifestyle costs are tracking almost identically for most professionals. The rule: invest aggressively in your career skills. Your earning potential is your biggest asset. Rule 11. Lifestyle inflation is a silent wealth killer. You get a 15,000 rupees raise, suddenly you need a better phone, a bigger flat, Zomato Pro instead of cooking, and the raise vanishes before it even arrives. The technical term is hedonic adaptation. We adapt to improvements incredibly fast and then just want more. It's completely normal human psychology, but it's completely destructive for wealth building. The rule: every raise, put at least 50% of it directly into investments before you ever see it in your account. Rule 12. Tax planning is not cheating, it's compulsory. First, understand the 2 worlds you're choosing between. Under the new tax regime, which is now the default, you get a 75,000 rupees standard deduction automatically. But ATC, ATD, HRA and NPS deductions are gone. Under the old regime, those deductions are available, but your base tax rates are higher. Here's what most people mess up. They pick a regime without doing the math for their specific situation. For a salaried person with a home loan, HRA and maxed ATC, the old regime can still win. For someone without those, the new regime usually wins. Under the new regime, that 75,000 rupees standard deduction alone saves someone in the 30% bracket 22,500 rupees every year. That's 22,500 rupees that should be in your SIP, not sitting unclaimed. The number of people I've seen who don't even know which regime they are filed under, it's alarming. Pick deliberately. Do the comparison every year because your situation changes. Legal tax optimization is literally financial self-defense. The rule, know your regime. Do the comparison math every year. Every rupee saved on tax is a rupee that compounds. Rule 13. Health insurance is not optional in India in 2026. Medical inflation in India is running at approximately 9.9% per year, the highest in Asia, per Mercer March Benefits 2025 Health Trends Report. A standard 5-day hospitalization in a private hospital in Mumbai or Delhi now easily costs 3 to 5 lakh rupees. Most people lean on their employer's group policy. Here's the problem. You lose that coverage the day you resign, which is exactly when you might be most stressed and vulnerable. An independent family floater plan of 25 lakh rupees coverage costs roughly 10,000 to 15,000 rupees a year for a 3 family in their 30s with a standard plan. That is genuinely one of the cheapest investments you will ever make. The rule, your own health cover, independent of employer, minimum 25 lakh rupees, no exceptions. Rule 14. Index funds will beat 80% of actively managed funds over 10 years. The data is clear. This is not an opinion. SPIVA India Scorecard 2024 data shows 76 of large cap active funds underperform the Nifty 100 TRI over a 5-year period after expenses. Extend that to 10 years and it's still 62%. Nearly 2/3 of actively managed funds over a decade couldn't beat the index. And yet, Indians have 23 lakh crore rupees in actively managed equity mutual funds, many paying 1.5 to 2% expense ratios, when Nifty 50 index funds are available at 0.1 to 0.2%. That 1.3% expense ratio difference on 10 lakh rupees over 20 years, 11.2 lakh rupees of your money gone in fees. The rule, start with low-cost index funds. Add active funds only with a specific researched reason. Rule 15. Diversification doesn't mean owning 15 mutual funds. If you own 15 different large cap mutual funds, you don't have 15 strategies. You have expensive overlap and a lot of paperwork. True diversification means asset class diversification. Indian equities, international equities, gold as a hedge, sovereign gold bonds or gold ETFs, fixed income for stability and your emergency buffer. That's it. 5 buckets. You can do that with 4 to 5 instruments. The rule, diversify across asset classes, not within the same asset class. Rule 16. The psychology of money matters more than the math of money. Here's a fascinating data point. Vanguard research found that investor returns trail fund returns by about 1.5% annually on average, purely due to emotional buying and selling at the wrong times. In India, Amphi data shows SIP stop rates spike significantly every time markets correct more than 15%. People know to buy low, but they feel the need to sell. Financial freedom isn't a math problem, it's a behavior problem. You need systems, auto debits, separate investment accounts, a written investment policy statement that remove your feelings from the equation. The rule, build systems that protect your future self from your present emotions. Rule 17. Your net worth number matters more than any other financial number you track. Most people track salary, some track savings, very few track net worth, assets minus liabilities. Assets, bank balance plus investment portfolio plus EPF plus real estate equity, not full value, equity. Liabilities, outstanding home loan plus car loan plus personal loan plus credit card balance. That's your number. And you should know it, updated every single month. Why? Because it keeps you honest. It shows you when a car loan is actually reducing your wealth even though the car is parked right outside. The rule, know your net worth number. Track it monthly, grow it deliberately. Rule 18. Financial freedom has a number. Calculate yours. Financial freedom sounds like a vague dream, but it's actually a very specific math problem. Annual expenses multiplied by 25 equals your financial freedom number. This is based on the 4% withdrawal rule widely accepted in financial planning globally. If your annual expenses are 12 lakh rupees, your financial freedom number is 3 crore rupees. That's when your investments generate enough returns to cover your life without you working. Most people have never calculated this number. They're running a race without knowing where the finish line is. The rule? Calculate your financial freedom number today, then work backwards to a monthly investment target. Rule 19. The best time to get rich was 10 years ago. The second best time is structuring a plan this weekend. Look, I know someone watching this is 40 years old and feeling like it's too late. I want to address that directly. A 40-year-old investing 30,000 rupees a month at 12% CAGR until age 65 accumulates 5.76 crore rupees. That's not a consolation prize, that's generational wealth. It's just a different starting point, not a closed door. The biggest financial mistake is not starting late, it's deciding the situation is hopeless and not starting at all. The rule, where you are is irrelevant. That you start from here is everything. Rule 20. Financial freedom is not about money, it's about time. This is the one I want to leave you with. The goal of all of this, the SIPs, the index funds, the emergency fund, the term insurance, is not to die with the biggest number in your bank account. The goal is to reach a point where your time belongs to you, where you can say no to a job you hate, where you can take a year off to be with your kids when they're small, where you can start that business without desperation, where you choose how every day begins. Money is the vehicle, time is the destination. Alright, 20 rules. Let me give you the one action I want you to take in the next 24 hours. Open a spreadsheet, write down your monthly income, write down your current monthly investments, calculate your savings rate, and write down, for the first time maybe ever, your actual net worth. That's it, just those 4 numbers, because you cannot fix what you haven't measured. If this video added some value to how you think about your money, please hit subscribe. I put out videos every week on exactly this kind of thing. Real data, real math, real talk about building wealth in India. Drop your savings rate in the comments. Genuinely curious. Let's see where everyone's at. See you in the next one.